Hello everyone, we are from Group 4 that consists of me, Aura Josiana, my friend Ayusa Fitri, and Arif Rahman Hakim. Today we are going to discuss about prospective analysis. Before we go to the material, we need to know what is the prospective analysis. It is the final step in the financial statement analysis process. This analysis can be carried out after the financial statement or adjusted accordingly to reflect the company's performance, and the prospective analysis is useful for the testing accuracy of the company's strategic plan. For this reason, it is necessary to analyze whether the company is able to generate sufficient operating cash flow from expected funding, or whether the company needs fund or equity in the future. It also necessary to analyze whether the current strategic plan will produce the benefit, like predicted by the company's management. Okay, next about projecting financial statement. The projection process begins with the income statement, followed by the balance sheet and the statement of cash flow. First is projected income statement. The projection process begins with the expected sales growth, and we have to consider to this situation. First is expected level of macroeconomic activities. Since target customer purchase are influenced by the level of personal disposable income, our analysis might incorporate estimates relating to overall growth in economic and expected growth of retail sales in particular. For example, if the economic condition be better, we can project that our sales is increased than the previous years. And the second is competitive landscape. Changes in the competitive landscape will influence our projection of unit sales as well as the target ability to raise price. And the last is new versus old store mix. New stores typically enjoy significantly greater sales increases than older stores, since they may poorly serve market or provide a more up-to-date product mix than the existing competitors. And here is the example of the projective income statement. All of the number is given by the book. And also there are several assumptions. And here the sales growth 11.455% come from sales in 2005 divided sales in the previous years, and the gross profit margin we get the number from sales minus cost of goods sold divided with the sales. And the other assumption is written in exhibits 9.1. And next to the example, there are the steps in projecting the report, and also the calculation of each step. Like the first step, to get the estimating sales in 2006, we get it from sales from previous year 2005 multiplied with the rate in sales growth. To get the gross profit, we calculate it with the result from the first step multiplied with the gross profit margin. And the third come from the estimation of sales in the next year minus the second step that we already calculate before, and so on. So you need to follow the book calculation because it is coherent, so it makes us easier to project the income statement and calculate it. And after we follow the 10 forecasting step, here is the result in exhibit 9.2. Okay, we can move to the projected balance sheet. There are forecasts of the balance sheets involve the following steps. First, project current asset other than cash using the projected sales or cost of goods sold and appropriate turnover ratios. The second, project of plant property and equipment increases with the capital expenditure estimate derived from the historical trend or information obtained in the management discussion and analysis section of the annual report. And the third, project current liabilities other than debt using projected sales or cost of goods sold and appropriate turnover ratios. And the fourth, obtain current maturities of long-term debt from the long-term debt footnote. Fifth, assume the other short-term indebtedness is unchanged from the prior year balance unless they have exhibit noticeable trend. Sixth, assume the initial long-term debt balance is equal to the prior period long-term debt less the current maturities from the calculation for above. And the seventh, assume other long-term obligations are equal to the prior year's balance unless they have exhibit noticeable trends. 8. Assume the initial estimate of common stock is equal to the prior year's balance. And then 9. Assume the retained earnings are equal prior year's balance plus or minus the net profit or loss and the less expected dividends. And the last, assume the other equity account are equal to the prior year's balance unless they have exhibit noticeable trend. And here is the example of the projected balance sheets. And how to calculate it is sequentially following the step that state in our paper, and it also use the same prior assumption like the projected of income statement. So we can move to the third projected statement of cash flow. The projected statement of cash flow is computed from the projected income statement and projected balance sheet. And this material will be handled by my friend Arif Rahman Hakim. Time is yours.
Projected statement of cash flow. The projected statement of cash flow is computed from the projected income statement and projected balance sheet. In this exhibit 9.5, the projected net cash flows from operation of $3,295 million partially financed the capital expenditure of $3,357 million, reduction of long-term debt in the amount of $504 million, and dividend of $276 million. The remaining deficit result in an $843 million reduction in cash. Sensitivity analysis. The projected financial statements are primarily based on expected relation between income statement and balance sheet account. In the previous example, we used the most recent ratio as target of operation are fairly stable and we are assuming no significant change in operating strategy. However, it is often useful to vary this assumption in order to analyze their impact on financing requirement, return on asset and equity, and so on. Analysis often prepares several projections to examine the best or the worst case scenario in addition to the most likely case. This sensitivity analysis highlights which assumption has the greatest impact on financial result and consequently help to identify those areas requiring greater scrutiny. Application of prospective analysis in the residual income valuation model. As we stated at the outset of this chapter, prospective analysis is central to security analysis. The residual income valuation model, for example, defines equity value at time t as the sum of current book value and the present value of all future expected residual income. As you can see in this formula, where BVT is book value of the end of period, T, RE per T plus N is residual income in period T plus N, and K is cost of the capital. Residual income at time T is defined as comprehensive net income minus charge on beginning book value, that is RET equal NET minus capital multiplied by the book value T means 1. The valuation process requires estimates of future net income and the book value of stockholder equity. In this slide, Exhibit 9.6 provide an example for the valuation of Siemens Corp common stock as of 2005. For better and more complete explanation, you can refer to our book, The Financial Statement Analysis, at page 516. But the main point is the valuation of equity share is critically dependent on the projection process, and our valuation should closely examine the sensitivity of share price estimate to underlying assumption in projection.
Hello guys, the next about trend in value driver. The residual income model defines stock price as the book value as stockholders' equity plus the present value of expected residual income, where RIT equal NIT less K B50 less 1. Residual income can also be expressed in ratio from as RI equal ROE, ROE T less K B50 less 1, where ROE equal NET defined by B50 less 1. This form highlights the fact that stock price is only in fact to so long as ROE less K. In equilibrium, competitive force will tend to drive rate of return or ROE to cost so that abnormal profit is completed away. In Exhibit 9.7 present ROE performance for quintiles of all firms in the computed database for each year, portfolio of firms in each ROE quintile of performance, and the ROEs for each firm in the portfolio are taken for the subsequent 10 years. The graph presents the median value for each portfolio. To observe our evidence from the first one, ROEs tend to defend to a long run equilibrium, and the second, the reversion is incomplete. Exhibit 9.8 presents a graph highlighting the reversion of net profit margin or NPM for the quintile of firm in the compute database. It has been constructed similar to the ROE graph in the exhibit 9.7. The market reference rate for the high and lows. The highest and the lowest NPM firm are evident. In addition, the reversion rate for the lowest profit firm is greater than that for the most